Most people think getting rich means earning more money. Wrong. The wealthiest Canadians do not live off income. They live off debt. And I am going to show you exactly how they do it. Here's what nobody tells you. Every time you sell an asset in Canada, the CRA's waiting with their hand out for capital gains tax. But when you borrow against that same asset, nothing. Zero tax. It is called the buy, borrow, delay strategy, and it is not some offshore scheme. It is completely legal in Canada. Banks see this every single day. In this video, I am going to show you how it works, why it is legal, and how you can use a version of this strategy, even for non-taxable. Before we dive in, if you want Canadian tax strategies that actually make sense, hit subscribe. This channel is basically everything the CRA will not explain properly, but in plain English. We post every week, so you will want to catch the next one. Let us start with something you already know. The CRA taxes everything. Your salary, taxed your business profits, taxed your capital gains, taxed. But here is what most Canadians miss. The CRA does not tax borrowing. When you borrow money, whether it is a mortgage, a line of credit, or a loan against your investment portfolio, you have not earned anything. You are just accessing cash that you are expected to pay back. That is why it is not taxable. Think about it like this. When you get your paycheck, you will notice deductions all over it. Income tax, CPP, EI. Your pay stub shows up pre-chewed. But when you borrow $100,000 against your rental property or your investment portfolio, the CRA does not care. You are not earning it. You are accessing it temporarily. So instead of selling an asset and handing the CRA a chunk of your capital gains, you can borrow against it, and the government does not take a penny. Once you understand this, you start seeing where the average Canadian burns tens of thousands in unnecessary taxes. So if borrowing does not trigger tax, why does everyone do the exact opposite? When you need cash, your instinct is to sell something. Sell your time, sell property, sell investments. And look, sometimes selling is the right call. If you need the money, you need the money. But here is the real cost. The moment you sell an asset, you turn a paper gain into a real one. And that is when the CRA wakes up and says, now we are interested. In Canada, 50% of your capital gain is taxable. So if you are in Ontario making over $253,000, you are paying roughly 27% tax on your capital gains. That is over a quarter of your profit gone immediately. But it gets worse. The tax bill is immediate. The asset is gone. It can never grow for you again. It is basically a one-way door. Borrowing flips that completely. You still get the cash. You do not trigger a tax event. And you keep the asset so it can sit there gaining value, compounding in the background. Yes, borrowing has interest. But in many cases, that interest is cheaper, and the tax you would pay by selling. This is not theory. It is how wealthy Canadians structure their lives. At this point, people usually say, yeah, but interest is expensive. It feels expensive. But feelings are a terrible way to make financial decisions. Let me show you the math. Let us say you have got an investment portfolio or rental property that is appreciated, and you want to access $100,000. Option 1. Sell. You sell part of the asset. 50% of your gain is taxable. If you are in a high tax bracket in Ontario, you are paying roughly 27% on that gain. Let us say your gain is $100,000. You are immediately handing the CRA about $27,000. No installments, no mercy. Option 2. Borrow. You borrow $100,000 against the same asset. Let us assume a 5% interest rate. To keep the math simple, that is $5,000 per year in interest. Even if you hold that loan for 5 years, that is $25,000 in interest spread over time. You still have the asset. It is still growing. And here is the kicker. If you are using that borrowed money for investment purposes, the interest is tax deductible in Canada. So you are not choosing between free and expensive. You are choosing between expensive now and manageable over time. This is where debt starts behaving in a way your brain does not like, but your spreadsheet does. If this is already changing how you think about taxes and debt, make sure you are subscribed. Everything we talk about on this channel comes down to structuring money properly, not just earning more of it. Hit that subscribe button so you do not miss the next strategy. This next part will probably give you whiplash because it goes against everything you have been taught. When I say the word debt, most people react like I have suggested funding retirement with scratch tickets. But what if I told you that when debt is backed by an appreciating asset, it starts to behave differently? Let us continue from our example. You have borrowed $100,000 against an asset you already own. You are paying $5,000 per year in interest. That $100,000 debt? Fixed. But the asset it is secured against? Not fixed. If the asset is growing at 5-7% per year, which is not unrealistic for Canadian real estate or diversified investments over the long term, then the asset is growing faster than the debt. In other words, the longer you hold it, the easier the debt becomes to manage. If your asset is growing faster than the interest rate, time starts paying the bill for you. Now, to be clear, this does not mean borrow recklessly and hope for the best. Cash flow still matters. Affordability still matters. You still need buffers. But once you understand this, the idea of never selling starts to make a lot more sense. And what happens if you never sell at all? That is where the G part comes. By now you might be thinking, okay, borrowing's great. But what does until you die even mean? First, let me be clear. Borrowing until you die does not mean. It means never triggering the tax event by selling. Because when you sell an asset, that is when you lock in a taxable event. You realize the gain, the CRA takes its cut, and that is permanent. But if you never sell, your assets just keep growing, and the debt you have taken against them keeps getting easier to manage as we discussed. Then when you die, things change. In Canada, when you pass away, the CRA treats it as a deemed disposition. Your assets are considered sold at fair market value. But here's the key part. Your heirs receive those assets at a stepped-up cost base. That means they inherit the assets at their current market value, not what you originally paid. So all the appreciation that happened during your lifetime, your estate pays capital gains tax on it at death, but your kids inherit it tax-free from that point forward. Example, you bought a rental property in Toronto for $500,000. It is now worth $1.05 million. You borrowed against it over the years to fund other investments. When you die, your estate pays capital gains tax on the $1 million gain, roughly $270,000 in Ontario. Your kids inherit the property at $1.05 million as their cost base. If they sell it for $1.05 million immediately, zero additional tax. Yes, there is still tax at death, but you deferred it for decades while the asset grew. And if you structured things properly, you minimized even that. Now let us talk about passing on that wealth, because that is the goal for most people using these strategies. Canada does not have inheritance tax or estate tax like the US or UK, but we do have deemed disposition at death, which triggers capital gains. Here are the main tools wealthy Canadians use to minimize that tax. 1. Spousal rollover assets can transfer to your spouse at cost base with no immediate tax. This defers capital gains until the surviving spouse passes away or sells. It is automatic for most assets, but you need to structure it properly in your will. 2. Trusts. A family trust can hold assets and distribute income to beneficiaries in lower tax brackets. This splits income across family members and can significantly reduce overall tax. Trusts are complex and expensive to set up, but for high net worth families, they are incredibly powerful. 3. Life insurance. Life insurance proceeds are tax-free in Canada. Wealthy families use permanent life insurance to create liquidity at death, covering the capital gains tax bill without forcing the sale of assets. You pay premiums during your lifetime, and your estate gets tax-free cash when you die. It is like pre-funding your tax bill. 4. Principal residence exemption. Your principal residence is completely exempt from capital gains tax. This is Canada's biggest tax shelter. If you have owned your home for 30 years and it is appreciated by $1 million, that gain is 100% tax-free when you sell or die. Do not waste this exemption. 5. Lifetime capital gains exemption. If you own shares in a qualified small business corporation or qualified farm fishing property, you can shelter over $1.25 million in capital gains tax-free. This is a massive exemption that most business owners do not use properly because they do not plan ahead. 6. Corporate class investments. These allow you to receive tax-preferred distributions like return of capital, dividends, or capital gains. It is a tool wealthy investors use to receive income and defer taxes indefinitely while staying liquid. If you are getting value from this, do me a favor. Hit subscribe and turn on notifications. Read down Canadian tax strategies like this every single week. You will want to catch the next one before you make a costly mistake. So how do regular Canadians actually use this strategy? You do not need to be a billionaire. You just need assets. Example 1. Real estate. You own rental property in Toronto worth $1.02 million. You bought it for $600,000. You need $100,000 for a renovation or another investment. Instead of selling and paying capital gains tax on $600,000, roughly $162,000 in Ontario, you get a home equity line of credit, HELOCs, at 5%. You borrow $100,000. Interest is $5,000 per year, and it is tax deductible if you use it for investment purposes. You keep the property. It keeps appreciating. You do not trigger any tax. Example 2. Investment portfolio. You have $500,000 in a non-registered investment account. You need $50,000 for a business opportunity. Instead of selling the investments, triggering capital gains, you get a margin loan or securities-backed line of credit. The bank lends you money against your portfolio. You pay interest, tax deductible. Your investments keep growing. One thing to note is for this strategy you need the right financial institution and the right investment asset. If you do not have either one, you will not be able to deploy this strategy. Our clients who work with us, we help them with both. Example 3. Business owners. Your corporation has retained earnings of $300,000. You need personal cash. Instead of taking a dividend taxed personally, you take shareholder loan or use the asset by providing a guarantee fees. The corporation lends you money at the CRA prescribed rate. You get the cash, no immediate tax. You repay it when it makes sense or refinance it strategically. These are not loopholes. They are how the Canadian tax system is designed to work. Before you run out and borrow against everything, let me be very clear about the risks. 1. Cash flow matters. You need to be able to service the debt. If you cannot make the interest payments, you are in trouble. 2. Asset values can drop. If your asset drops in value and you are heavily leveraged, the bank can call the loan. This is what destroys people in market crashes. 3. Interest rates can rise. Variable rate debt becomes much more expensive when rates go up. Factor this into your planning. 4. You need buffers, emergency funds, multiple income sources, conservative loan-to-value ratios. Do not max out every line of credit you can get. 5. Get professional advice. Tax rules are complex. Interest deductibility rules are specific. Estate planning requires expertise. Do not wing this. This strategy works brilliantly when done right, but it can also blow up spectacularly when done wrong. The bottom line: the wealthiest Canadians are not sitting on piles of cash. They are using debt to unlock wealth, letting their assets grow without giving up control, and deferring taxes sometimes for decades. If you want to play the same game, it is not about earning more. It is about structuring better. The Canadian tax system rewards those who understand it and plan ahead. Now here's what I want you to do. First, if you have not already, subscribe to this channel. We break down Canadian tax strategies every single week. Turn on notifications so you catch them. Second, if you live in Ontario and want help applying this to your situation, there is a link to see if you are fit with our team. And finally, share this video with someone who is thinking about selling an asset to access cash. You might save them tens of thousands in unnecessary taxes. Thanks for watching. I will see you in the next one.